Hi, everyone. Logan Hertz here with Hazeltine LLC. Let's continue responding to comments. So, Mr. Gavel, 2856, comments on our first and HELOC case study video. He says, I would simply use cash flow index to prioritize which debts to attach first. Before combining in the HELOC, I would calculate the interest savings versus cash flow gain. Thank you for your comment. Yep, that's a great idea. Cash flow index can work particularly well, especially if you're using a first lien HELOC. For those of you who do not know, cash flow index is one of a multitude of different techniques for prioritizing which debts you're going to pay off first. And there's really no one right or wrong way to do it, but cash flow index looks at your debts from a cash flow perspective. It's answering the question, if I pay off that debt, how much cash flow am I freeing up? And I want to point out, if you look at, say, a 30-year mortgage from a cash flow index standpoint, the mortgage looks really good because from a cash flow efficiency perspective, a 30-year or even a 15-year mortgage is very efficient because your monthly payment is very low relative to the amount of debt that you have. If you pay off your mortgage, assuming you're in the early phases of your mortgage, you're throwing a lot of money at a debt that's not going to free up a tremendous amount of cash flow relative to the amount you're putting into it. With cash flow index, you take the total debt that you have and you divide it by the monthly required payment. The larger the debt is relative to the monthly required payment, the more efficient that debt is, not necessarily from an interest rate perspective, but from a cash flow perspective. And so it's telling you how much cash flow am I going to free up for the amount of money that I'm paying it. We could get more deep into it. But anyway, it's a great way of prioritizing debt. Debt snowball is another one. Debt avalanche is another. There are others out there. But yep, I agree. It's a great way of looking at it. And then he comments again and says, I'm doing velocity banking with a first lien HELOC. I went with the all in one loan and love it. Great to hear. Keep it going. Then he comments again and says, right now I'm using the all in one loan to pay down our other debts first, cleaning up some credit cards and car debt. After that, we will probably be leveraging to buy assets. It shows us paying off our mortgage in 7 years, but we are leaning towards using the line to chunk to buy assets for more cash flow. Would you be completely debt free in like 8.5 years, or being debt free is not the end goal? Try to maximize cash flow aside from your day job. So thanks for your comment. And that's a great question. There is no one right or wrong answer. I think the question he's asking is, what is the end game with velocity banking? For some people, it's just to become debt free. They utilize velocity banking as the most efficient method of eliminating all of their debts. And then at that point, they're done with velocity banking. And that's totally fine. Some people utilize velocity banking to buy assets. So they have their first lien HELOC, they utilize it to pay down or pay off their debts to a point where they're comfortable. So they paid off all their toxic debts. Maybe the only debt they have left is their first lien HELOC, and they've paid it down to a point that they're comfortable. And then they use their first lien HELOC to buy assets, especially cash flowing real estate. So I had Greg Farricielli on my channel. He uses his first lien HELOC on his primary residence to purchase real estate, and then he'll take the cash flow from that real estate, feed it back into the first lien HELOC to replenish his borrowing ability and rinse and repeat on the process. It's just the flip side of the same coin. You use velocity banking to pay off debts, and then you can also use velocity banking to acquire assets. Both are great. Thank you for your comments. Then Jevin Martin 2250 comments on our use a first lien HELOC to invest in real estate video and says, what is the LTV you lend on with the first lien HELOC on rental property? I take it that this HELOC will report on the LLC side, not to your personal DTI. Am I wrong to say that? Thank you for your question, Javon. This is a specific question. I generally don't address these because it's missing the point and it's specific to you. The answers to these questions are specific to you. And I need to understand first, what are you trying to use this for? Let's back up. What problem are you trying to solve with the first lien HELOC? Let me understand that first, and then we can contextualize these answers. And of course, the answers change all the time. You say, what is the loan to value you lend on? Well, the answer to that question changes. Lenders' standards will change over time. But I would say presently, You could get up to a maximum of 80% loan to value on a rental property. Subject to change, not all the lenders will give you that. And you say the first lien HELOC will report on the LLC side, not to your personal DTI. This is a common misconception. I sometimes get people who tell me they want to do a first lien HELOC on a rental property. They come in, they already know what they want to do. They don't really want to listen to me or take my advice. They just want to ask very specific questions like this one because they view me as just some kind of robotic order taker and they just want to fill in some blanks. And my question back to them is why do you want to take out a first lien HELOC on a rental property? Why not on your primary residence? And they're just like, no, no, no. I don't want to do, nope, I don't want to do it on my primary residence. Well, why not? Okay. And the reason they're saying that usually is because they have this misconception that it's safer somehow to take out a first lien HELOC on a rental property or on an investment property rather than on their primary residence. Once you understand how this works, you understand it's exactly the opposite. It's actually less risk and more efficient to take out a first lien HELOC on your primary residence, even if you're using that first lien HELOC for investment purposes. And there are many reasons for that, which I'm not going to get into in this video. There could be reasons to do a first lien HELOC on a rental property, just so we're clear. I'm not saying that's wrong, but usually the place to start is your primary residence for a lot of very good reasons. The terms are going to be better and it's actually safer. The question he's asking goes back to the misconception that somehow, if I have a rental property and it's in an LLC, that's somehow separate from me. And if there are problems with that first lien HELOC, it'll somehow be in this self contained LLC and it won't come back on me. That's false. That is false. It absolutely will come back on you. So do not think just because you have a rental property in an LLC that it's somehow separate from you. And if there are problems with it, it won't come back on you. No, it will. It will. Unless you have gotten to the point where you really have well and truly divorced your business credit from your personal credit, which is very difficult to do, takes a lot of time and effort, and typically a lot of money. Typically, you would have a C Corp, not just an LLC, if you're going to do that. And there are people that I've spoken to and I've had on my show who help businesses to do that. But typically, these are businesses that have lots of money flowing through their business. That is not an easy thing to do. And you would probably know if you had done it. Again, I'm not giving specific advice because the answer is always it depends and on your situation. But generally speaking, it is more risky to take out a first lien HELOC on an investment property rather than doing it on your primary residence, even if you're going to be using it for investment purposes. In terms of how the credit reports, typically, again, there's no one size fits all solution. There's no one right answer to that question, but typically it will absolutely 100% be attached to your personal credit. It is not separate from you. You still have your personal guarantee behind it. Otherwise, the bank is not going to lend to you. So do not be under the illusion that this rental property that you have in an LLC is somehow separate from you. This is why fairly large real estate investors like Craig Farricielli and others use a first lien HELOC on their primary residence, not on any of their investment properties. It's actually safer to do it that way. It's possible that you could have your business credit separate from your personal and then it wouldn't report on your personal credit, but it's extremely unlikely. If you had gone through the exercise of well and truly separating your business credit from your personal credit and having a business credit profile that does not have a personal guarantee attached to it, you are a very unusual person. And you would probably know if you had done that. And probably you have $50 million trucking business or something like that. Thanks for your question. It is a good question. All right. Danielle Nolte, 3579, comments on my combining first lien HELOC and velocity banking video and says, I invest in real estate. Couldn't you just buy term policies and take the money you would put into a whole life policy and invest it into rentals? In that case, when you die, your family keeps the cash value, whereas the whole life policy, they don't keep anything you put into the policy. I could buy a couple million in term policies and buy rental properties, keep all the cash value, and get an appreciating asset that pays me every month while I'm still alive. I currently have about 1.1 million in life insurance term policies and I make about $4,600 a month after expenses in rental income. Plus, those assets are being paid down and will pay me more when paid off, and I'm not paying for them, my tenants are. Thank you for your comment, Daniel Nolte. Greatly appreciated it. So I'm not exactly following you, but I think I am. First of all, could you do what you're talking about? Yeah, and there'd be nothing wrong with that. You could buy term life insurance policies, just get term life insurance on yourself, and then take the money you would have put into a whole life policy and invest it into rental real estate. That's a buy term and invest the strategy, but instead of investing the money into the stock market, you're investing it into real estate. And there would be nothing wrong with that. That would be perfectly fine. However, when he says, when you die, your family keeps the cash value, whereas the whole life policy, they don't keep anything you put into the policy. That's false, actually. If you have a whole life insurance policy, you absolutely do keep everything. If you had a $1.1 million whole life insurance policy, when you die, your family gets the full $1.1 million. So they do absolutely keep everything you put into the policy and then some. This is why we call it a leveraged death benefit. As a real estate investor, I'm sure you appreciate the importance of leverage, meaning that no matter how much money you put in that policy, you will always get more out of it on a guaranteed basis. Either when you die, your family gets the death benefit, or while you're alive, you can use the cash value and it will grow to be more than what you put into it. So you always keep the cash value because the cash value is part of the death benefit. Cash value is the net present value of that future death benefit. So if I have $500,000 in cash value in my policy, I might have a $2 million death benefit. When I die, my heirs get 2 million, which is significantly more than $500,000. So what's the problem? I don't see the problem with it. As a real estate investor, the analogy I would use is cash value is your current equity position in the policy, and death benefit is the total value of the policy. I would recommend taking out a convertible term life insurance policy for your full human life value. And I can tell you what your human life value is. That's what your future net worth should be if you manage your affairs properly. And the life insurance company will give you the formula. Let's just say it's $5 million. It might be more since you're a real estate investor. I don't know if 5 million is a lot for you or not, but let's just say it's $5 million. Take out a convertible term policy for $5 million, and now you have full optionality. You can convert that policy over time to whole life if you want, or you can just leave it as term. It's up to you. I would say putting money into whole life insurance policies is like putting money into real estate, except that you don't have the risk or headaches associated with real estate. Now, the drawback is, of course, you're not going to get the phenomenal returns that you can get in real estate. The answer, in my opinion, is you should do both. And what you should do, Daniel, potentially, is use your whole life insurance policies to finance the purchase of those rental properties. Instead of using a bank to buy the rental properties, you can use your own private bank to finance the purchase of those properties where you own the property and you own the mortgage. Or use your whole life insurance policy to finance the down payment on a rental property and then use a conventional mortgage or a first lien HELOC to finance the rest of the property. There's nothing wrong with term life insurance. That's totally fine. I would just say that you and your heirs do get the cash value. Absolutely. Thank you for your comment. Let us know what you're doing and how you're progressing. Dr. Financial Literacy put another comments in here, says, yes, the rates were similar, maybe because I was getting the HELOC on the investor property. He is commenting on my first lien HELOC explainer video. And there's a series of comments and responses here that I'm not going to go into because it's unclear what exactly he's saying. There were some discussion around interest rates. Again, this is why I don't answer specific questions because it just leads to confusion on interest rates and things like that. When someone is asking a specific question, invariably that question comes from a preconceived misconception that needs to be addressed, or it's just not helpful for a broader audience. That question might be helpful for them in their specific situation, but it's not helpful and it's confusing and misleading for the audience as a whole. This was getting into how interest rates compare first lien HELOC versus second lien HELOC, primary residence versus investment property. The answer, of course, is they're going to be different. A first lien HELOC, generally speaking, is going to have a lower interest rate than a second position HELOC. And then either one of those HELOCs, if it's on your primary residence, generally speaking, is going to have a lower interest rate than on an investment property. But that's also assuming all things are equal. That's why I generally put out general principles and try not to get too deep into specifics because the more specifics you get into, the more it's just misleading. But thank you for your comment. I appreciate it. Denzel Rodriguez comments on our Velocity Banking Answering Objection series. This is a response video to a video that Denzel Rodriguez did with Todd Langford. And he says, great video. I was shocked they didn't use whole life as a better way to pay off the mortgage. They were pretty confident on just using a high yield savings to beat velocity banking over a long period of time. Part two is coming out soon, and Daniel Ronberg will be on that recording. Thanks for your comment, Denzel. I really appreciate it. Denzel has been on the show more than once. I've been on his show, and Denzel is one of the foremost velocity banking experts out there. I do not consider myself one of the foremost experts on velocity banking. I know enough to be dangerous. I talk about it on my channel, but I'm really more of an expert on the infinite banking concept. When we talk about velocity banking, I'm usually trying to bring someone on my show like DeAndre Clayton or Denzel Rodriguez, who's gone much deeper into it. But thank you for your comment, Denzel. I will look forward to that next video. Hero Boy Kuka, I'm sorry, I'm probably not pronouncing that correctly, also comments on the first lien HELOC explainer video and says, this calculation is so misleading. I compared first lien HELOC strategy with conventional 30-year loan plus extra payment to principal, the same total amount as the HELOC, and found that the 30 years is actually pay less interest. The only big advantage is you can take money out in the HELOC while you can't do that in traditional mortgage. Thank you for your comment. I appreciate it. You are correct. If you compare a 30-year mortgage to a first lien HELOC, assuming the first lien HELOC has a higher interest rate and you have the same amount of total cash flow going to each one, you will pay off the 30-year mortgage faster. That is true. What you're basically saying is don't do velocity banking. And now let's compare a 30-year mortgage to a first lien HELOC. And as we've said before, the first lien HELOC only makes sense if you're doing velocity banking because it's not a realistic comparison. As always, the problem is never the numbers. The problem is always the assumptions behind the numbers. The reason the first lien HELOC works to pay off your house faster than a 30-year mortgage is because it enables you to safely throw your entire income and liquid savings at the housing debt. If you have a 30-year mortgage, you cannot safely throw all of your income and all of your liquid savings at that debt. You would have to have some amount in liquid savings somewhere as an emergency fund and an opportunity fund. And you couldn't throw every red cent you have at the mortgage. You would have to hold some back in order to pay bills. The reason the first lien HELOC works is because we're now throwing a lot more cash flow at the principal and therefore paying it off much faster. We can throw all of our liquid savings and opportunity fund and emergency fund into the HELOC and throw all of our income into it because we can pull it right back out. It's fully liquid. We can pull money right back out anytime we want. So, yes, your calculation is correct, but it misses the point. If you're not doing velocity banking, then the first lien HELOC doesn't make a lot of sense. Thank you for your comment. I appreciate it. Any Torniak says, okay, awesome. What about putting $3,000 per month in ETFs for 7 years while you can remove it anytime you want? Sure, you can do that if you want. I think you're saying instead of putting $3,000 a month into the HELOC, you could put it into ETFs and just earn a return. Sure, absolutely. You can do that if you want. Velocity banking is not for everyone. It's not the only strategy. So that would be fine too. We could go into some details on that as an example. Obviously, in those ETFs, you're taking on market risk. That's something to consider. You're taking on market risk, whereas in the HELOC, you're not taking on that risk. If the market crashes, you didn't lose any money in your HELOC. Whereas in your ETFs, you would lose money. You'd have to pick those ETFs correctly. And depending on where it is, you'd have to pay taxes on it. Whatever gains you're earning in the ETF will be taxable. You couldn't use the ETF to refinance other debts the way that you could use a first lien HELOC. But again, that's perfectly fine. If you say, I just want to keep my mortgage and put $3,000 a month into ETFs for 7 years instead, you could absolutely do that. Could it work out better for you? It could. We don't know. It just depends on how comfortable are you with that amount of risk, is the question. I would say it's an apples versus oranges comparison because are you looking for the most efficient debt elimination tool? An ETF is not a debt elimination tool. It's an apples versus oranges comparison because the ETFs are investments. But you could do that. Could it work out better for you in the long run? It could. It absolutely could. If you're getting 12, 15% on the ETFs, that certainly could. But it's an apples versus oranges comparison. But if you want to do that, sure, go ahead and do that. No problem. Thank you for your comment. I appreciate it. Stacy Wilkes, 184, comments on our Velocity Banking with a First Lien HELOC interview with Anthony Rushing. Says, love your program. I'm starting to fully understand it. I've heard, though, that the banks are starting to require that the borrower use 70% of the HELOC limit right off the bat. Is this true? And can you elaborate? Thank you. Thank you for your comment, Stacy. I appreciate it. I've never heard that, so I would love to hear where that's coming from. None of the lenders I work with require you to use 70% of the HELOC limit right off the bat. Nobody I know requires that. They do oftentimes have minimum draws, but it wouldn't be a percentage of the limit. As an example, a bank might require a minimum $100,000 draw. If you did a first lien HELOC and you owed less than 100,000 on your house, they would require you to draw 100,000, which you could then pay right off if you wanted to. You could pay it off immediately. So I've never heard of that. And then I told her basically that, and she says, that's great to hear. Thank you so much. Then I asked her where you heard it, and she said, it came from someone that I'm thinking about working with, but don't want to say his name out of respect. I'm not sure where that came from. It could also be a misunderstanding, too. Sometimes there's misunderstandings and miscommunications. It could be that that person is just talking about the minimum draw that sometimes applies, which, yeah, there usually will be a minimum draw because the bank needs to make some money. They need to be able to charge some interest. Otherwise, it doesn't make sense from the bank's perspective. That's where that minimum draw amount will oftentimes come in. Thank you for your comment. I greatly appreciate it, Stacy. Let us know how you're doing.